Hello, everyone. This is Triffany Hammond. Thank you for being here today. I am the founder at triffx.com. That's Triff as in Frank, X as in X-ray.com. And I'm here today to go over some basic support and resistance type stuff. I like to drill down, which for me, what that means is I start with a larger time frame. My largest time frame is the daily chart. And then I move to the 4-hour chart, and then I pull most of my triggers off of a 1-hour chart. So we're going to talk about what that looks like and the importance of putting price and price action in a larger context before taking a trade. So you have a general idea about where things could go next and what behavior's sort of setting up to do in the long term, and that helps you create your trading plan while things are calm in the marketplace, while you're not looking at, some crazy active candle and just anxious to get in, right? Because it's all about being prepared and ready to take the trade when it triggers. So, Ray was so nice to say, he also seconds my intentions about the International Traders Conference. Before I go on into talking about the Euro-Dollar, I really want to talk about my experience at this conference. And first of all, I want you to understand that this isn't just to promote the conference or make you feel bad that you weren't there or anything, but from the context of working with students, and a lot of the students I work with are kind of still in the toddler phases of their education. That means, they've got the basics down, they speak the language, they have a basic understanding of what's going on in the marketplace, but they really haven't honed in on what their routine looks like, what their trading looks like, how to evaluate what's working and what's not working. There were all kinds of levels in terms of the students there, but this particular conference really drove home the importance of having the ability to talk to other traders. If you go to expos and you go to some of these, really large events, a lot of time most of the time, you don't get a chance to really interact with the people that are trying to teach you. And this event, if you can, I strongly encourage you to save up your money and try to go next year, because there were so many opportunities to get to know the speakers, to get to know other traders, to get to ask specific questions in real-life trading conditions. And you know how it is when you're trying to work with somebody that you consider, you like the way they trade, you can identify, kind of a good personality fit, and you say to yourself, geez, I just wish I could sit at their dinner table. I just wish I could pick their brain. I wish I could sit and next to them while they trade and talk about the way that they make their decisions. This is a conference that accomplishes all that. There was a panel discussion at the end of it that it took a few questions to kind of get a real discussion going, but once the discussion going, it was as though everyone who was sitting in the audience was listening to those of us speaking like we were sitting at dinner debating the benefits and detriments of just fundamentals, just technicals, how to integrate them. And we had opinions across the board. And I remember when I was learning, that was what I wanted to be a fly on the wall for. I wanted to hear real honest discussions like that. And that wasn't the only opportunity to do that. So this is a chance for you to really kind of begin to surround yourself with the kind of people that you're trying to become. Good traders, consistent, disciplined, with your own unique view of the marketplace. You're just not going to have an experience like this anywhere else out there in the educational market. There's just nothing else like it. So if you can, save up for it. Come next year. They're just an absolute incredible setup, incredible group, and a wonderful experience, I think, for everyone. So it's not a plug. It's an absolute honest take on the whole experience. So I hope that you'll come next year. So in regard to trading today, let's talk about the Euro-Dollar. Let's talk about what this Euro-Dollar is doing here. You can see here on my chart, I have the daily chart up. And remember, I start with a longer time frame, and I move down to a smaller time frame. So right off the bat, these levels are levels that were put on there during the last discussion 2 weeks ago. So I'm going to take them off. You'll be surprised we'll end up right back on there just because I'm talking to you about it. So right off the bat, what I see going on here, and if you've been trading with me for a while, you're going to know what I'm going to talk about. You're going to anticipate what's going to come out of my mouth next. But here, can you see all these long wicks? Small bodies, right? Long wicks, small bodies. And even in the context of, even though these bodies aren't small, can you see the indecision in there? A trader's first responsibility is to learn to understand price action. And when you have a strong bullish move followed by a strong bearish move, what you really have is that tug of war that I talked about in the marketplace between the buyers and the sellers, right? Nobody at this point, and here we have the opposite, a strong bearish push and a strong bullish pull. And right now, nobody in the market has control over price right now. We've got a lot of strong indecision. And even though it's arguable, right, it's not textbook. Forex patterns rarely are textbook. Because my brain sees patterns, that's just the way my brain is wired, I see a little head and shoulders. Now, I'm not trying to pick tops and bottoms, okay? I'm just identifying that possibility that there is strong enough rejection of resistance of higher prices, right? And large enough indecision as the price bumped up above 40 and then 41, right? Strong enough power to resist that we are potentially looking at a reversal. Potentially, right? The setup is there. Now, we won't actually have confirmation until we get a close below the neckline of a head and shoulders. We won't know that it's a head and shoulders until we get a close below the neckline. For me, that would be right about this level here. And what I'm doing is I'm cutting the difference between this wick and these extremes, kind of in the muddy area, right? So a more conservative trader is going to wait for a close below these candles altogether. Mine's sort of an interim place to, kind of a medium aggressive type trade, and then somebody who's super aggressive is going to be cutting off the bottoms of these candles altogether and taking a level that looks more like this, where we have more bodies and grabs some of these wicks that were created during this indecision up in here. Okay, so we won't know that this has been a triggered reversal pattern until we see a close below. You pick your favorite. Are you super aggressive, somewhere in the middle like me, or super conservative? And then that will confirm that this pattern has been triggered. Do you understand what I'm saying? Because the setup is right there doesn't necessarily mean it has to be triggered. We don't have to be looking at a reversal. Very dangerous to pick tops and bottoms. Very tricky thing to do, and you don't want to get caught up in that zeal that happens when we start thinking it's done, it's overdone, and just start risking too much and getting crazy on the reversal. That's what makes counter trend trading so difficult, is finding that entry point. So if this is not going to trigger, then what would it look like if there was more upside? Well, we have a lot of indecision between the top of the bodies of this area of indecision, basically the bodies of the shoulders, right? And the absolute extreme the market was willing to go as it approached 1.42, so about 41 and a half, right? This is our big muddy area. So if this has more upside, a conservative trader is going to be looking at a close above the absolute extremes before that trader is convinced that this pair is going to go longer, right? A super aggressive trader is going to look at another close above about 39 and a half, at least as a place to start taking advantage of some of that testing that the market does when it starts to play with a continuation after such a strong consolidation. Okay? Maybe they're not going to hold on to 145 on a break above 1.3950, but they might be looking for some pushing from the buyers to try to see if there's enough money out there to continue to push price upward. So an aggressive trader is going to take a close above 139.60. Now remember, we're still talking about a daily chart. We're talking about very large ranges. But the reason why this discussion is important, even before we go down to the 1-hour chart, is we have to be looking at the levels that the big market makers are looking at. And believe me, they're looking at the daily chart and they're looking at the 4-hour chart. Even the scalpers have an idea of what's going on in the daily chart and the 4-hour chart, because that's where the big decisions are made. So these levels are super important. Someone like me, if I'm going to take a long, I'm probably going to be looking at something in here where I'm cutting the difference between my absolute extremes to the top side, my absolute extremes to the bottom side, and finding some place in the middle. And honestly, 1.40 was tough to break the first time, right? And so 40.5 is going to be a really smart place for me, in my mind, this makes sense to me, to take a trade as the market is pushing those levels again to see if there's enthusiasm on the buy side of the trade. So those are my two plans, right? What to do if it goes short, what to do if it goes long, and those are the levels that I'm willing to watch. Any questions before I move down to the 4-hour chart? I told you we're going to beat this one up because it's at critical levels right now. We're really talking about a place where the market's trying to understand, first of all, where sentiment is right now, and second of all, where's the momentum picking up? Which direction is the momentum picking up on this trade? Because nobody wants to be the one that's betting against, big money, even big money itself. Adrian asked a good question. How do you define strong, bullish, or bearish? By small wicks or by candles and pips? Generally speaking, the sentiment is the strong sentiment is wrapped up in the candle body itself. Indecision begins to appear in your wicks. So if you have a small body, there's not a whole lot of, the market's not really convinced of either direction, right? Same thing with wicks, because if you think about it, Adrian, if you're looking at any of these candles with these long wicks on them, okay, any of them, what you're talking about, let's look at this one right here, the one that, yesterday's candle, right? At one point, the people who thought that the euro was a good buy, even as high as it is, even without a pullback, the people who thought that the euro was a good buy were able at one point to push price up really close to 141. And you see this wick right here. It goes really close to 141, which is a pretty critical level for the pair since it's been rejected so many times. And all that resistance is being built up every time we get closer to 141, right? Remember, it was 140 for a while. And then once it hit 140, it shot to 141 just fine. So now that next level is being, all of that drive by the marketplace is sort of they're getting a feel for it near that 141 level. So the buyers at one point had strong control within the context of this daily candle. But what happened? The sellers came in and took back all of that control. Not only took it back, from the extreme, but almost completely down to the extreme to the opposite side, almost to the shortest that it went during the course of the day. And in fact, was able to drive price completely back to the opening price that it opened for the day. So we're talking about all of that indecision is being shown in this push and pull that is simply expressed by the language of a candlestick. So strong bullish or bearish candle is going to be one that gives us a good strong body. Let's take a look at today's candle. Right now, the day has opened very strong to the bearish side. Now, we don't know where it's going to close yet, but we can certainly see the sentiment being wrapped up in the very strong bearish move. So price opened up at the top of the body. At one point, the buyers tried to nudge it up, and it just didn't really have much buying power in it at all. And since then, price has been able to steadily and surely continue to go lower. So that large body is showing a strong bearish sentiment going on right now. So that's how I define strong bullish or bearish. That's how I define indecision. And really, your understanding of what that opening price is compared to the close price, compared to the action that happened during the course of the day, that is your primary responsibility, in my opinion, as a trader. You have to understand what volatility looks like on price, what decision looks like on price, what divergence looks like on price. You can see divergence in price alone. So it's your job to understand what the market is telling you in the language that the market speaks. And the only language the market speaks is whether or not they're buying or selling. And that is expressed to us in the form of candlesticks. So Adrian, does that make sense? It's a good question. Hopefully that makes sense. I'm going to go ahead and move on. So that's the discussion on the daily chart. We've talked about possible longs, possible shorts. We don't want to get married to either side of that trade. I think everyone right now sort of has good, I'm glad that made sense. I think everyone right now sort of has a bearish bias to the marketplace simply because the euro has been so extended and then overextended for so long. However, trends can go on for much longer than we ever think that they can. And that's all we need to understand, is that we have to watch for either side of that trade. The market can do whatever the heck the market wants to do, whether or not it makes sense to us or not, right? So with that in mind, we can now move down to the 4-hour chart, which for me is my interim chart. Now, if you like to scalp, if you like a 5-minute chart, then your interim level would probably be about a 15-minute chart, and then your longer-term level may be a 30-minute or a 1-hour chart. So what I'm talking about really can be applied to any set of time frames. This is just I'm telling you how it is that I trade it. So, FUTIS, this seems that the 1.4 is the key from yesterday and 2 days back-to-back close. Price action at close below 1.4 in my opinion. Well, that 1.4 is really a key level right now because it has been tested, and remember, it was so tough to break. It was so hard to break. Everything, the market would push toward that level and then kind of freak out, right? So that is very much a key level right now. But really, when we look at that longer-term chart, we can kind of begin to see that the real decision-making is going to happen between 141 and 142, because the market was able to easily drive to 141 without much problem. But it hasn't been able to yet create enough excitement, enough enthusiasm from that next break of the psychological number, right? So that's kind of what, would confirm that the market really wasn't going to give us any kind of pullback at all, and instead was going to look at further longs. But right now we don't know what the market's going to do, right? Right now we're looking at a large area of indecision, and that's really all we need to do. So we have to say, what's our area of indecision right now? So on a 4-hour chart, we can very easily see, and actually if we were to pull this back, it's going to look more like a triple top, right? Or even arguably that head and shoulders again. But we've got 3 strong peaks, again, sort of setting up the potential for a reversal on here. When we come in closer, we can actually see we have a pretty large area of indecision, right? We can see all this resistance for the break to the long side. That's that 1.41 level. And we can see that the market, even though it was willing to pull back off of that level, off of the enthusiasm especially that drove up to that point, it wasn't real thrilled about going short yet either, right? And that gives us sort of an irregular consolidation, very typical once a pair is tired out. And we can see in here that we have an area of indecision that now we have a chance to sort of make some plan around. Now the 4-hour candle that's closed last actually would have triggered a trade for me if I had been watching it to take a trade. I'm actually, because I just got back, I spent a lot of time on Facebook this morning adding pictures and talking to people. So I wasn't watching the charts at all, to be honest. But that would have triggered a trade for me. It would be a close outside of the area of indecision where that wrapping up, that sentiment from the marketplace is wrapping up. Now, I trust the horizontal levels more than I trust the diagonal levels or the trend line. However, if someone were to get really technical, they're going to be talking about this in terms of a higher, with the higher lows and the lower highs. And actually, they probably would have done this, and this trade would have triggered a trade for them anyway, right? So it's a triangulation. This is that triangulation that happens when the market becomes undecided, unsure of itself, and that is our opportunity to put together a plan. So if you like the trend line break, that would have broken. For me, I don't take a trend line break by itself. It has to coincide with a horizontal break as well, which the last candle did quite cleanly. But this is still talking about this on a 4-hour chart, right? On our 1-hour chart, we can see here that our candle close below the trend line chosen would have been this one here. Do you see that there? The next candle, because I wait for the close below the horizontal level that I'm watching, because the horizontal levels seem to hold stronger. The reason I do that, let me tell you why I do that. Because very often we can get a close below the trend line, right? And then it hits that horizontal level and then just bumps along sideways. And that's all the market wants to do while it continues to wind up this sentiment, this, big strong swing, interim swing, and then that tight swing can happen, and it can be very deceiving because it can happen after a trend line break. So the person that's going to take that trade, that's going to take a trend line break, they're going to get a better risk to reward on the trade than I am, but they're going to end up with more fake outs than I am. So it depends on, what is important to you in terms of how you like to see your trade set up. So if I had been in this particular trade right here, if I had taken my break would have been 1, 2, 3 hours ago, take that trade, because each one of these candles was fairly bearish, a retracement up to about that level seems typical to me. Actually, in the live trading sessions at the ITC, we talked a lot about what I'm going to tell you here next. Not only does it not bother me, you know that feeling you get when you feel like you've entered into a trade, and as soon as you're in a trade, the market goes against you, and it feels personal. And I think that's where a lot of people feel like, brokers hunt their stops, and because as soon as they're in a trade, the market goes against them. That's really typical for people who are still kind of in the beginning stages of learning. But let me tell you, not only does it not bother me that as soon as I enter this trade, I see some indecision, I actually want it to go against me a little bit for 2 reasons. One of them being I can take a second trade at a better price. But the other one being, and this is even more important, if this price is going to break out, pull back, break out, pull back, break out, pull back, then the market is then behaving normally. And I like to be in trades when the market's behaving itself, when it's minding its manners. I don't like to be in a trade when the market is behaving impulsively. Because once it's impulsive, then there's no real guidepost for me to be able to understand when I should hold on to a trade and when I should get out of a trade, where I should add to my positions or where I should scale out of my position. There's no real indicators in price for me when the market becomes impulsive. So for 2 reasons, I actually kind of like when price shows this little indecision, but even better, a pullback. So you can see how after gaining some experience in the marketplace, these little, you can start to look at price and market behavior and just go, it is what it is. It's not bad that price is going against me right now. It is what the market is doing. That just is what the market's doing right now. It's what the market does when it behaves normally. Therefore, this is actually a strong trade to be in, right? So for me, my stop loss goes 2 minor support and resistance levels inside the consolidation area. So here's one, right? The one we just identified. Oops. And here's 2. And then my stop loss is going to go a little bit above there. Because I'm taking my trigger on a 1-hour chart, I feel very comfortable looking at this as a possible trade for 100% of the area of indecision down to, and actually, okay, the reason I choose the 200% extension level is generally when the market chooses a range that it's willing to move in. Once it breaks out, it's willing to move that same amount of pips that it was willing to range in. That's the reason for this 200% extension level. In the instant that I put this line on here, I actually see a profit target I like better based on the fact, let me mark it separately, based on the fact that once price moved away from this last area of indecision, it did not get retraced. Can you see that in here? So that makes this a high probability, high volatility profit target, meaning that once price breaks and breaks strong, we're going to see very quick and decisive movement down to those levels more often than not. So even though I normally go for the 200% extension level and then I adjust a little bit for support and resistance, this is a much safer profit target for me as I look at it now, looking back at these levels, and that's going to make sense for me. Generally speaking, on the way to the 200, these three lines, the 38, the 50, and the 61.8, end up being a place for the pair to pause anyway. So since I have a good strong profit target in there, wait for that to hit it and then watch for a fresh setup. So I'm not gonna feel like I have to hold on to that 200% extension level just to get a good price movement on the pair, right? Or make a good trade out of the pair. So I should get a nice, good, fresh consolidation level right around that 150 anyway. And then I have another level down in here that's gone unretested, and another one down here. So you can see how if this is a true reversal, if this does end up being the absolute top to this price action, then I have a chance at times over to see reasons for the market to aim for the next numbers that they're going to aim for. And during the times that they're sort of taking their pauses and pullbacks, I'll have a chance to make a plan for each leg of that trade. Questions, comments, concerns? And then we'll talk about what I'll be looking for if this is wrong, if the short is wrong, and I'll be looking for a long. Yeah, a little bit above there, Ab. Yes. So I'd be looking at about, say, 125 pip stop loss to a 385 pip profit target. Mus says, if you take this trade on the basis of support breakout, what is your take on the notion that breakouts are only 30% true? I don't really have a take on the notion. I know what works for me in my trading statistically, and as long as it works, I'm not really going to care about the rest of it. The reason why breakouts, especially in Forex, and it's a really good question, I don't mean for my answer to be kind of decisive, right? Dismissive. But really the reason why breakouts are tough is because everyone's going to have a kind of a different definition of what the breakout really looks like. You saw even when I was looking at the daily chart how we talked about three different levels. If you're conservative, if you're aggressive, or if you're somewhere in the middle. So right off of the bat, you're talking about a pretty wide range depending on someone's risk profile, on their ability to take the trade. Not only that, but we're talking about breakouts in Forex, right? So we're talking about huge amounts of money, huge amounts of volatility that changes, right, from the time that we have session overlaps to the time that we have session gaps. To the time, I mean, the volatility in the marketplace changes from one extreme to the other depending on what time of day it is, news announcements, that sort of thing. So I think one of the reasons why it's easy to sort of quantify that breakouts, are minimally successful, is the fact that a breakout is going to mean something different to everyone, right? I like to take advantage of this tightening up because it allows me a good risk to reward on most of my trades. And I have a lot of different mile markers along the way of my trade. So I'm not just taking that breakout. I'm taking the pullback. I'm taking the second breakout after that pullback's been confirmed. I'm taking, when it levels off and breaks out again, I'm taking that again. So the way that I scale into my positions, it works really well for me to trade the way that I'm describing to you. Now, what we're talking about then is this is the way that breakouts make sense to my head. Now, honestly, there are plenty of traders that when things are going sideways, they don't see any pattern to it. It just looks scrambled up and confusing. That's fine. So they wouldn't trade the way that I'm trading. And if they tried to, because their brain isn't wired to see the pattern the way that I see the pattern, if they tried to, they wouldn't be successful at it. It's just that simple. They would fail at it miserably. So I don't mean to just dismiss the idea that breakouts aren't profitable, but I know that the way I've learned to trade is profitable for me. So what someone else thinks, if someone has to say that it's not profitable, I have to say, okay, not profitable for you, right? So I don't really have a take on that notion because it doesn't apply to me. Nicholas Stack says, what is your timetable for take profit? 2 to 3 days or a week? Sometimes my trades hit profit in a day or two. I've held on to trades as long as even on an hourly trigger, 2 or 3 weeks. And then, of course, if I do take a 4-hour trigger or a daily trigger, I'll hold on to the trades for weeks and months, right? Remember, I started off of the daily chart. So, my first experience in the daily chart was really holding on to trades for a very, very long time. So for me, going down to holding a trade for a day or two most of the time on an hourly chart, and that's a speedy trade in my mind. How do you gauge speed? What do you mean, how do I gauge speed? Speed once price is moving, or I don't understand the question. Ask it in a different way, and I'll see if I can answer it better. Yes, once price is moving. Well, keep in mind, if you've been trading with me for a while, you've heard me talk from time to time about, or if, sometimes too people ask the question, do you watch fundamentals at all? That kind of thing. I do have a good idea of what's coming out on the calendar each day. I keep a spreadsheet, of the associated or the related news announcements for each major news announcement. So, for instance, I'm watching, all through the month, I'm watching manufacturing surveys so that by the time I see the GDP coming out, I have a good idea of what the market is feeling about GDP. So, with that in mind, I know I generally have a good idea of what is about to trigger some momentum in price. So speed, once price is actually moving, I can tell if it is price moving as a result of the market pricing into their expectations about a fundamental announcement, or I can tell if it's the economic announcement itself. And then you can identify, I don't go down into a 15-minute chart and a 5-minute chart. Like, none of that matters to me. I just don't go that low. I have found that the time frame I want to take my trigger on is the time frame I want to watch for my analysis. So when I see that momentum picking up, even within the context of an hourly chart, usually I have a good idea of why it's picking up momentum. And I can identify time of day, right? So past the half-hour mark, I'm going to have a lot more volatility between 10:20 and 11 o'clock than I am in that first hour. I'm going to have a lot more speed and momentum pick up in the last part of the hour than I am in the first part of the hour. Why? Because first part of the hour is usually some kind of profit taking from the last hour. So there's a little bit of a pullback, a little bit of a pause in the first part of the hour. Second part of the hour, things pick up. So you'd be watching hourly candles and yes, I do not go down and start playing mind games with myself off of a smaller term time frame. It is a rare trader that can take a trade on one time frame and watch objectively price on a shorter time frame. I'm really glad you asked this. That's a very dangerous thing for traders to do, because then what begins to happen is all of the decision making ends up, first of all, you're looking at price action that falls outside of your trading plan, right? So for me, if I make a trading plan off of a daily 4-hour and a 1-hour analysis, and then I move down to a 15-minute chart to watch that price, I don't have anything objective in front of me telling me if this, then that. If I want to take a trade here, or if price reacts this way to this level, then I don't have that in front of me because that's not where my analysis was. Not only that, but what would normally look like on a normal pullback or even top of the hour profit taking on a 15-minute or a 5-minute chart is going to look pretty flippin' scary, right? And it's going to make me second guess everything that I put together when I was feeling calm, cool, and collected. So I think it's very, very dangerous to go shorter term to watch price. I think it's very dangerous to watch price move at all, to be honest. Even though I'm looking for pullbacks and stuff, I'll check it. I'll check my charts every couple hours. I'm not sitting here staring at price. The market's going to do what the market's going to do, and me staring at the computer is only going to stress me out. Yeah, that's a tough one. It really is. Thank you, Michael. I did. Yes. Did have a safe trip, although I'm still very sleepy. Very, very sleepy. But thank you. It was so nice to meet you and your wife. Absolutely delightful. Yeah, that's a tough one, and a lot of people do. It bothers people to walk away from their charts because they've just put their money, the things that are going to pay their bills, buy their groceries, put clothes on their back, get their mortgage paid. They just put all of that money out at risk. And it's sitting out there, and it's very difficult to sit at your computer feeling powerless once that money is on. So, you're kind of at the whim of the marketplace at that point. So it's a real big temptation to watch on a shorter term time frame. Is momentum picking up my way, or is it going against me? But trust me, you're going to play more mind games with yourself, and you're going to absolutely destroy your own trading psychology by doing that. So do something else for a while. As a busy trader, how much time do you spend in front of the computer? I spend a lot more time in my planning stages than I do in my trading stage. I'm perfectly honest with you. I will spend an hour or two as I close up shop. Okay, so let's start with a Sunday, okay? I actually do my trading plan on a Friday afternoon, but you could do it Sunday morning before the market opened, whatever, because price isn't moving between Friday afternoon and Sunday morning. Well, that's U.S. time, right? But between Friday close and Sunday open, somewhere in there when everything's quiet, that's when I spend the bulk of my trading plan. I'll spend an hour or two looking at the economic calendar, comparing it to all of the related news announcements that came out before, looking at so if I'm looking at crosses, I look and get a feel for what both sides of that cross are doing, and all that goes into my trading plan. It goes into my analysis before the markets even ever open. And then, so my typical day when I get up in the morning, most of you know, I spend the first half hour in meditation, and then I'm looking at, what did I miss overnight? What announcements came out? What effect did they have? Was there something that happened that wasn't on the economic calendar? Did somebody make an announcement or a speech or something? And I get a feel for what's going on in the marketplace. And then come New York open for me, I start watching for my triggers, because that's where I get most of the volume I need to trigger the trades that I have. And then I do my webinars and I help my students, and I do all of those other things. But in terms of actual trading time, staring at the computer, staring at price action, if I added it all together until it's time to make my end of day analysis and plan again, an hour, 2, maybe, if I have a lot of trades on. I don't obsess over the charts once I've got my trades on. I don't. And then at the end of New York close, beginning of the Asian session, right in there, I'm putting together my plan for the next day again, but then I don't look at the charts again until I wake up. How many trades do you place on average per week? On average, I'd say about 3, but I can go as low as none if I have no setups, and I've had as high as on my hourly trades. I've had as high as maybe half a dozen. How do you manage overnight risks? You get up in the middle of the night to check and manage your trades? No, I don't ever. No. I used to. I used to, because of the way that I used my money management. I used to really like, and this was a real good confidence builder for me for a while, putting on my position and taking half off after it hit a certain amount of profit. And so for me, that European session would hit my first profit target, and I'd have alarms sent to my cell phone, so I knew that I had to go move my stop to break even. And so I used to do that. But oh my gosh, what a flippin' nightmare. It's no. So yeah, and even then it wasn't like I have to check on my trades, I'm scared about my trades. It was because I had action to take on my trades. Hit the profit target, gotta go protect the trade. But I think that's another very dangerous trap to get into, and it's a huge temptation when you're a beginner. It's a 24-hour market, and you feel helpless going to sleep with trades on. But you'll get there. It comes with experience and time, and once you kind of get to the point where you're able to go, you know what, it's going to do what it's going to do. As long as you have hard stops in and profit targets, it's going to do what it's going to do. You've protected yourself with your money management. You've protected yourself with a plan, and, if you get stopped, if you could have, 10 taken profit if you had been awake and you get stopped out. That's just going to happen sometimes. It's just part of trading, and you have to go, well, it is what it is. I mean, honestly, folks, we have to do that with life, right? I was on my way back. I went from Barcelona to Amsterdam to Minnesota to Denver. So the flight to Amsterdam landed at the time that my boarding pass said I should be boarding my second plane. And there was a big temptation there to freak out about that, right? As I said, well, everything happens for a reason. I'm going to just keep going, and, I have to still do what I have to do. I can't control that. There's nothing I can do about that. So I walk through, and I get to the customs part. We have to walk through to get to the second leg of the flight, and it's an absolute sea of people. There's no organization. It's hard to even find the lines. There's no sense between which one's taking the Euro passports and which one's taking the U.S. passports, and there's big columns that are covering the signs, and everybody's milling about and freaked out and panicked. And the people around me are complaining about this. Oh my gosh, this is ridiculous. I'm supposed to be, and I told them, I said, we can't control that, but we can control staying calm, and we can get to know one another, and we can, learn a little bit about each other and make this a positive experience instead of a negative experience. And so we actually had, we got to know each other, and I met some really cool people from all around the world, and this ended up being an experience. It all worked out fine. Granted, I got onto my plane at the last possible second that they were letting anybody on, but it all worked out. And the truth of the matter is there's so much more outside of our control than we have inside of our control in our life. And the only thing we can do about that is embrace it. Because if we fight it, we're going to be creating stress in ourselves, or our body's going to react to that stress and make us sick. We're going to create, we're going to end up being one of those personalities that's just angry about everything and nothing's ever going to make you happy. I mean, we have a choice at every single moment whether or not we absolutely fall apart or whether or not we just embrace that moment. It's the same thing with the market. We can't change what it does while we're sleeping, but we can make sure that we're well rested for when we get up in the morning, right? We get that choice. We get to say, well, whatever's going to happen overnight is going to happen, but I'm going to get some good sleep so that in the morning I'm equipped to deal with it. You have control over that. That's the only thing you have control over. So you might as well make a wise decision within the constraints of the control that you have. So Nicholas says, like yesterday, I was long dollar Swiss and up 30 pips, moved to break even, and then stopped out this morning. But my analysis was correct. How do you manage once you're up in profit? Usually quickly. Oh, yeah. Trailing stops, even manually, are a tough thing. 30 pips doesn't sound like, depending on the time frame that you're trading. I don't know what time frame you're trading. But it's rare that I move my stop to break even after a 30 pip move. I will move my stops up, no problem. I have no problem doing that, but I still keep that general rule of thumb of 2 minor support and resistance levels. I don't have just a standard pip amount that I'm willing to move it to, because what usually happens is you'll get stopped out at break, because things pull back, right? They move up and they pull back. So if you move to break even on the move up, when they pull back, they're going to hit your break even and then go back up. So it's just, I dropped big lots, but I guess that's why I moved. I dropped big lots. I guess that's why I moved. Oh, yeah. So you were being extra conservative about it. Okay, well, that's fine. But you still have to understand, if the market's going to behave normally, it's going to drive one direction and then pull back the opposite. That's normal behavior for the marketplace. And once you can wrap your head around that that's what the market does, then you can start to put your plan in place to accommodate that as opposed to fight it. It's due for a pullback, right? So you got to give it enough room to pull back and still protect as much of your capital as you can. Good comments, good questions. Remember, it's easy when we're learning something because we feel insecure about it. it's easy when we're learning something to kind of become obsessive and scared and micromanage our trades. But trust that even if you're managing your trades today because that answers a need you have, you're feeling paranoid, you're feeling scared, whatever, trust that if you stick with it long enough, you will gain confidence in normal movement in the marketplace. You'll gain confidence in your experience and your ability to identify what normal movement looks like. And over time, that confidence will come. It's like anything. If you were asked to give a speech on something that you just learned yesterday, you're not going to feel confident enough in your expertise to be able to give that speech, to contribute your opinion to the world. And that's what you're doing when you take a trade. You're contributing your opinion of the world, of that pair, right? But you're doing so on a minimum amount of experience. You have to do it. You have to put yourself out on the line like that to gain the experience. You have to take those risks to get better at it. So understand that that's just part of your process, and that over time you'll be able to sleep through the night. Over time you won't feel so scared about protecting profit. Over time, you'll still protect profit, but it won't come from being fear-based, right? Over time, those things will come, but you have to manufacture experience in the meantime and get yourself to the point that you're able to do that. Oh, I see what you're saying. There's no easy, fast answer for that, Nick. I'm sorry. Would you consider your trading method to be a naked trader? Yeah. Although I do have charts that do have an 800 simple moving average and a default setting MACD, but I would still consider myself a naked trader because I don't use those to trigger a trade. There's nothing about those things on my chart that tell me when to get into or when to get out of a trade. So, yeah, absolutely, because it's all price action based. Those things are on my chart just kind of for my own edification, just because I find them curious. Yeah, exactly, Fuji. How can you apply it on the pound dollar as an example to benefit from today's move? Well, I'm running out of time. So I can't go into a whole other, but in fact, I should be wrapping up right now. How do you use the MACD then if you use it? It's just kind of, when I see divergence in price, I like to see if there's also divergence on the oscillator, but it doesn't trigger anything for me. So it doesn't really mean a whole lot. So another announcement today, I'm actually going to be taking some time off. My business has been around for over a year now, and I've got to take some time to consider what I need that business to look like moving forward. And it's very difficult for me to be objective about that when I'm in the midst of everything. So it actually works out really well for me right now to take some time off. So I'm not going to be here next week. I'm going to take November and December and come back and revisit in January. So I hope you'll still watch for me, come back then, yeah, great luck to you and everything in the meantime. Here's my blog if you want to stay in touch with me. triffnfx.com. You can stop by. There's not much going on right now as it's kind of winding down for this break, but that's where I keep in touch with my students and all that good stuff. So I'll be keeping my eye on it from time to time. It's not going to be a daily thing. So please come visit if you'd like. Thank you so much for being here today. I missed you last week, and I hope that you will consider taking a look at saving up and joining me or joining FX Street at the ITC next year, because it is an absolutely fantastic event, one that I think is just really unique and gives incredible opportunities for traders. So thanks, everyone. Take good care of yourselves. Starts with you, right? Bye-bye.